The official story is clean. In October 1907, panic swept American finance. Banks failed. Credit froze. The New York Stock Exchange collapsed by nearly 50% from its peak. And Congress, responding to the crisis, acting on behalf of the public, spent the next 6 years debating, revising, and ultimately constructing a modern central banking system. The Federal Reserve Act was signed into law on December 23, 1913, a democratic solution to a structural problem. That version appears in every standard economics textbook. It is the version taught in universities. It is the version the Federal Reserve's own institutional history endorses. It is also incomplete in a way that changes everything. The legislation was not designed in Congress. The central architecture of the Federal Reserve, its structural logic, its key provisions, its fundamental answer to the question of who controls money when the system cracks, was drafted over 10 days at a private hunting club on a barrier island off the coast of Georgia by the most powerful bankers in America, in a meeting so deliberately concealed that participants used false names for the entire duration. The congressional hearings came later. The political debate came later. What Congress debated, and what Woodrow Wilson signed on that December morning in 1913, was a revision of something that had already been decided, in private, behind closed doors, by the institutions it was supposed to regulate. This is the story of Jekyll Island. To understand why this happened, you have to start with the autumn of 1907, and with what the panic actually revealed about the American financial system. The United States in 1907 had no central bank. It had not had one since 1836, when President Andrew Jackson allowed the Second Bank of the United States to expire, convinced that a central banking institution represented a dangerous concentration of power in private hands. What replaced it was a patchwork. Thousands of independent state and national banks, each holding its own reserves, each capable of triggering a crisis by refusing to lend to its neighbors at exactly the moment when lending was most urgently needed. When the Knickerbocker Trust Company, then one of the largest trust institutions in New York, began to buckle in. October 1907, the effect spread immediately. Depositors lined up outside its doors. Other institutions, fearing contagion, called in loans and hoarded reserves. Credit markets seized. In the course of that autumn, the American economy came close to a complete financial breakdown. What stopped it was not government action. There was no mechanism for government action. The Treasury Department released funds. Secretary of the Treasury, George Cortelyou, deposited approximately $25 million in national banks in an attempt to stabilize liquidity. It was not enough, and it was not fast enough. What actually stopped the panic was one man. J. Pierpont Morgan, 70 years old, already one of the most powerful private financiers in the history of American capitalism, convened the presidents of New York's major banks and trust companies in his personal library on Madison Avenue. He locked the doors. He presented the mathematics of the situation clearly. The system would survive or collapse together, and survival required immediate collective commitment of capital. He kept them there through the night, sometimes literally standing between men and the exit, until they agreed. When they emerged in the early hours of November 2nd, 1907, they had pledged enough capital to stop the collapse. The New York Stock Exchange, which had fallen nearly 50% from its peak, began to stabilize. The intervention worked. The panic subsided. But the political class understood, immediately and clearly, what the episode had demonstrated. The American financial system had been saved not by its design, but by the personal will and private fortune of a single aging man. If J.P. Morgan had been unavailable, unwilling, or dead, the result might have been different. Reform was no longer an ideological preference. It had become a structural necessity. Congress established the National Monetary Commission in 1908 to study central banking systems around the world and recommend a path forward. Senator Nelson Aldrich of Rhode Island, the Commission's chairman, one of the most powerful men in the Senate, whose family connections to the Rockefeller banking interests were well understood in Washington, was tasked with producing that recommendation. By the autumn of 1910, Aldrich had visited Europe, studied the Bank of England and the Reichsbank, and consulted with banking authorities across the continent. He had a clear sense of what the United States required. What he needed now was a document, specific, legislative, defensible before Congress. And he needed it written by people who understood the technical architecture of modern banking more precisely than any senator or Treasury official could. He knew exactly who those people were. On the evening of November 22, 1910, a private railcar was attached to a southbound train at Hoboken, New Jersey. 6 men arrived at the station in separate groups, at separate times, careful not to be seen together. They addressed each other by first names only. Their luggage carried no identifying tags. Several of them had told their offices they were going duck hunting. Their destination was Jekyll Island, Georgia. The Jekyll Island Club had been established in 1888 by a consortium of American millionaires: Vanderbilts, Rockefellers, Morgans, Pulitzers, who purchased the barrier island off the Georgia coast and developed it as a winter retreat, accessible only by private launch, membership limited, and non-transferable. At its peak, the club's members reportedly controlled roughly 1/6 of the world's entire wealth. The island had no permanent civilian population. It had no press. It had no traffic except the traffic its members permitted. The men in that rail car represented something approaching a comparable concentration. Nelson Aldrich was there. The senator, the commission chairman. Henry Davison was there, senior partner at J.P. Morgan and Company. Paul Warburg was there, a German-born partner at Kuhn, Loeb and Company, widely regarded as the most technically sophisticated banking mind in America, who had spent years advocating publicly for a European-style central bank on American soil. Frank Vanderlip was there, president of National City Bank of New York, then the largest bank in the country. A. Piatt Andrew was there, Assistant Secretary of the Treasury, and Benjamin Strong was there, then a senior Morgan associate, later to become the first president of the Federal Reserve Bank of New York, and arguably the most consequential figure in American monetary policy for the following decade. By one participant's later estimate, the men assembled at Jekyll Island that November represented approximately 1/4 of the total wealth of the entire world. The club's staff had been briefed in advance. No surnames, no acknowledgement of identity. Guests were to be addressed by first name only. No correspondence was to leave the island with identifying information. They stayed for 10 days, and they drafted a plan. Before we trace what that plan produced, and what it failed to produce, you have to understand the one structural question the Jekyll Island drafters had to answer, because everything that follows depends on it. Every central banking system in history has had to resolve the same question. The answer embedded in the architecture determines everything else. The question is this: in a financial crisis, who decides how much money flows into the system, and at what price? The answer determines whether a central bank operates in the public interest or in the interest of the institutions that fund it. It determines whether the lender of last resort is constrained by the needs of private capital or empowered to override them. It is, ultimately, the question of whose crisis gets managed, and whose does not. The document that emerged from Jekyll Island, the Aldrich Plan as it became known, proposed a National Reserve Association with the surface appearance of federal oversight and the internal architecture of private management. The association would be centrally organized, with branches across the country. It would hold member bank reserves. It would issue currency. It would function, in practice, as a central bank. Its governing board would be drawn primarily from representatives of the member banks. This was not an incidental provision. It was the structural center of the design. The institutions supplying the capital would also hold formal authority over the rate at which that capital moved through the system in a crisis. They would set the discount rate, the cost at which money was available to banks under pressure. They would determine the conditions under which credit expanded or contracted. Paul Warburg, who had done more of the actual technical drafting than any other participant, later acknowledged that the European central banks they were using as models operated under considerably stronger public governance constraints. The Jekyll Island draft, in his view, had tilted the balance toward the private side of the equation, far enough that he doubted it would survive congressional scrutiny unchanged. He was right, but not for the reason he expected. The Aldrich Plan was released publicly in January 1911. It failed almost immediately, and not on technical grounds. Senator Nelson Aldrich's name was on the cover, and Aldrich's relationship to Wall Street was not a matter of speculation. His son-in-law was John D. Rockefeller, Jr. Progressive newspapers called the plan the Wall Street Bill. Populist Democrats, remembering Andrew Jackson's war against the Second Bank, saw exactly what they had always feared: private banking power formalized into public law. The 1912 election changed the landscape entirely. Woodrow Wilson swept to the presidency on a platform that explicitly targeted financial concentration. Democrats took Congress. The Aldrich Plan was, in political terms, dead. What replaced it was the Federal Reserve Act of 1913, sponsored by Senator Carter Glass of Virginia and Representative Robert Owen of Oklahoma. It was framed as a rejection of the Aldrich approach. Wilson signed it on December 23, 1913, and it was presented, and broadly understood, as a victory for public accountability over private interest. In its internal architecture, it was recognizably continuous with what had been drafted in Georgia. The regional Federal Reserve banks, 12 of them, distributed across the country, would be owned by their member banks. Those member banks would hold stock in the regional institutions and receive a statutory dividend of 6% annually. The Federal Reserve Board in Washington would exercise oversight, its members appointed by the president. But the regional banks retained substantial operational authority, including the authority to set their own discount rates subject to board review. 3 participants in the Jekyll Island session had advised directly on the final legislation. Paul Warburg communicated technical recommendations through intermediaries throughout the drafting process. Frank Vanderlip and Benjamin Strong were both consulted at key stages. The structural logic worked out in Georgia in November 1910 was legible in the statute Wilson signed 3 years later. The political theater had changed entirely. The architecture had not changed enough to matter. For the first decade of its existence, the Federal Reserve operated in relative obscurity. The Great War disrupted everything. Credit expanded to finance the effort, inflation followed, and the sharp recession of 1920 and 1921 came when the Federal Reserve tightened aggressively to restore price stability. Then came the long expansion. By the mid-1920s, American banks held the largest concentration of monetary reserves in the world. European economies were struggling with war debt and the difficulty of returning to the gold standard. American capital flowed outward in the form of loans to Germany, to Britain, to Latin America, and domestically, the mechanisms the Jekyll Island draft had established were working precisely as designed. Credit was available at accessible rates, and it was expanding. Bank credit in the United States grew from approximately $18 billion in 1920 to $28 billion by 1929, a 55% expansion in 9 years. Call money, short-term credit available to brokers for stock market speculation, was available at historically low rates and historically high volumes, exceeding $8.5 billion in brokers' loans alone By late 1929, consumer installment credit extended into furniture, automobiles, and appliances, financing a decade of consumption that had no precedent in American economic history. Benjamin Strong, by then running the Federal Reserve Bank of New York and functioning as the dominant force in American monetary policy, understood the risks. He had spent years in coordination with Montague Norman at the Bank of England, negotiating interest rate policy to sustain the international gold standard. He knew that the American credit expansion of the late 1920s was built on a foundation that required continued expansion to sustain itself. In October 1928, Benjamin Strong died. He was 55 years old, his health destroyed by years of work that had no precedent and offered no model. His death left the Federal Reserve without its most decisive figure at the moment when decision would matter most. In the summer of 1929, the Federal Reserve raised interest rates. The stated purpose was to check stock market speculation, to slow the flow of credit financing the extraordinary equity run-up of the decade. In August, the Fed raised the discount rate to 6%. On October 24, 1929, the New York Stock Exchange experienced its first day of panic selling. On October 28th and 29th, Black Monday and Black Tuesday, the market collapsed. The Dow Jones Industrial Average lost nearly 25% of its value in 2 trading days. What followed was not a managed correction. The Federal Reserve, now operating without Strong and divided between the regional banks and the Washington Board over questions of authority and mandate, did not respond with a unified, aggressive expansion of credit. The New York Fed moved to ease. The other regional banks resisted. The Washington Board was uncertain of its legal authority to override them. The internal architecture of the institution, the distributed power, the balance between private member interests and public oversight, the structural ambiguities the Jekyll Island framers had never fully resolved, produced paralysis at exactly the moment when decisive action was required. Over the next 4 years, approximately 9,000 American banks failed. An estimated $2 billion in depositor savings was destroyed. Bank credit contracted by nearly 1/3. Unemployment reached 25% by 1933. The institution designed in 1910 to prevent exactly this kind of cascading systemic collapse had, through internal disagreement and structural failure, allowed the largest financial catastrophe in the country's recorded history to run its course. In 1963, economists Milton Friedman and Anna Schwartz published their analysis in A Monetary History of the United States. Their conclusion was direct. The Federal Reserve's failure to act as lender of last resort between 1930 and 1933 did not simply fail to prevent the Depression. It converted what would have been a severe recession into the Great Depression. The structural question the Jekyll Island drafters had answered, who governs the system in a crisis, had been answered in practice. The answer was, no one, clearly. The ambiguity built into the design for political reasons to make the legislation passable in 1913 had produced a machine with no defined operator when it mattered most. In February 1935, Frank Vanderlip published an account of the Jekyll Island meeting in the Saturday Evening Post. He named the participants. He described the aliases, the private railcar, the 10 days of drafting under assumed identities at the most exclusive private club in America. He explained that the men assembled there had represented close to a quarter of the world's wealth and had spent 10 days designing the institution that would govern American money. He wrote it plainly, without apology, as a matter of historical record. The Saturday Evening Post in 1935 had a circulation of nearly 3 million readers. Vanderlip's article appeared. It was read. It generated no significant legislative response. It produced no congressional inquiry. The Federal Reserve continued to operate, its foundational narrative largely undisturbed. The reason is not difficult to understand. By February 1935, the Depression was the story. Unemployment was still above 20%. Roosevelt's administration was deep into the New Deal. The Banking Act of 1935 had already restructured the Federal Reserve significantly, centralizing more authority in Washington, strengthening the board's governance over the regional banks, addressing some of the structural ambiguities that 1913 had left open. The debates of 1913 felt distant from the emergency of 1935, and the question of who had drafted the original legislation seemed less urgent than the question of how to prevent another catastrophe of the kind the legislation had failed to prevent. The simpler version had a 22-year head start. It was already in the textbooks, already institutionalized in the official narrative, already doing the work that founding stories do, generating the consent and the stability that an institution requires to function. The Federal Reserve needed to be understood as a public safeguard, a democratic response to private recklessness if it was to command the credibility that a central bank requires. A founding narrative centered on a secret meeting of private bankers who designed the institution to govern themselves was not useful for that purpose, regardless of its accuracy. The truth was always available. It was in Vanderlip's memoir. It was in Paul Warburg's published papers. It was in the archives of the National Monetary Commission. The Saturday Evening Post printed it in 1935 for 3 million readers. The problem was never access. The simpler version was just easier to teach. The official story began with a democratic response to a crisis. It was clean. It was useful. It was incomplete. The Federal Reserve was designed at Jekyll Island by men who understood, in the autumn of 1910, that the next panic would not arrive with J.P. Morgan available to lock bank presidents in his library until they agreed to act. They designed a mechanism to replace that intervention. They built it according to their best technical judgment, under the political constraints that would allow it to become law. And they concealed the design process because they understood, correctly, that knowledge of its authors would have made it politically impossible. What they built failed in the first serious test. Not entirely, not permanently, but at the moment that mattered most, with consequences that took a generation to partially repair. The structural question they answered at Jekyll Island, who governs the system when it fractures, had been answered with insufficient clarity in ways that the political compromise of 1913 had only compounded. The Federal Reserve has been reformed many times since. The Banking Acts of 1933 and 1935, Bretton Woods, the abandonment of the gold standard in 1971, the emergency interventions of 2008. Each reform answered some of what the Jekyll Island design had left open. New questions replaced them. The original document, drafted in 10 days at a private club in Georgia by 6 men using false names, representing interests they were not publicly acknowledging, is still legible in the institution that exists today. Not in its entirety, not without the changes that a century of reform has layered over it. But the structural decisions made in November 1910 shaped the mechanism that has governed American monetary policy for more than 100 years. Every institution that describes itself as a public safeguard was designed by someone. The question worth asking is not what the institution claims to be, but who held the pen when the architecture was decided, and what that architecture actually required when it was tested. The answer, in this case, was always in the record. The question is whether that's the version we find easier to remember.